welcome to another one-to-one mining investment online content session. Today we're going to be hearing all about gold markets. I'm very pleased to have Rosa Gobitz, who is the research analyst at MacKenzie based in New York, to be taking us through their outlook on gold at the moment and how gold miners have been performing. So Maria, I'd like to hand over to you and please take us through your presentation on gold outlook beyond the price.
I'm going to run through the gold outlook and some of the trends we see on the supply side. Some key points. How has the economic risk propped up the gold price? Are we about to reach gold peak? And the flattening and declining reserves trends? And why are producers adopting a cautious approach to project development despite positive economics? At the beginning of the year, gold was benefiting from a late-stage equity bull market. We were focused on the US-China trade deal and rising geopolitical tension in Iran. So we were looking forward to an annual average gold price of $15.25 per ounce. Then things began to change as the coronavirus started to spread around the world, and this set up a series of events that changed the world around us. And many of these events were huge drivers for the gold price. As we saw the world was plunged into chaos, so was the gold price. First, we saw the gold price rise as the coronavirus cases outside of China started to rise, even as the market started to sell off. However, gold's safe haven qualities were called into question in early March when the World Health Organization declared a global pandemic. We saw everything being sold, even gold. Then the Fed took the rates to zero and announced unlimited QE to combat global deflation. So the outlook for the low rates and the low treasury yields are fundamental drivers for higher gold prices. And based on this, we expect an average gold price of $16.75 for 2020. There is naturally a lot of talk and excitement at the moment surrounding how high can the gold price go. A number of industry participants are calling for 2,000, 3,000, and some are going even higher with their projections. It certainly does seem like a conducive environment for gold to move higher, but when we look at where the 2019 annual average price cap cuts into the total cash plus sustaining cost curve, we can see that at those levels, 98% of gold miners are cash positive. So any upside really becomes a question of what miners are going to do with their extra cash. It is very clear that some investors with a shorter time horizon would like to see money returned to them in the form of dividends, whereas those with a longer term lens are getting a little uncomfortable with some of those shortening mine lives and would definitely like to see some investment in growth and securing longevity. The big players at the top, such as Barrick and Newmont, have the luxury of doing a bit of both. They have both announced an increase in dividend payments, but also have a number of projects in the pipeline, both at operating assets and greenfield projects. But for the most part, others are having to choose, and a few could still strengthen the health of their balance sheets. Reserve attrition continues to be a key risk in the gold industry. For several years, producers have been mining ore at reserve grade, or in many cases above it, which has aggravated the natural reserve attrition we're seeing in the industry. The chart on the left shows the global mine production is forecast to remain fairly constant over the near term. However, the mine closure rate is significantly outpacing the rate at which new mines are being commissioned. You can see on the right-hand chart, the average mine life has shortened from over 14 years back in 2012 to below 10 years, which suggests that the concept of gold peak is one to be taken seriously. While focusing on just reserves paints a concerning picture, it is important to remember that miners still hold a robust resource profile. Despite not meeting the criteria to be deemed economical extractable, they should not be overlooked. Just incorporating about 25% of the total reserves will extend the average mine life of the industry by approximately 3.5 years. We arrive in this position because exploration budgets were slashed following the fall in the gold price in 2012, and they have since failed to recover. The slight rebound in exploration spend that we have seen over the past couple of years has largely been focused on brownfield projects and near mine developments, which has not been sufficient to replenish mined ounces. Over the past few months, exploration activities seem to be turning a corner, but it really could be a while before this translates into reserves and ultimately into production. The 2020 exploration budgets are slightly higher than those in 2019, but are not enough to make significant difference quite yet. The increasing appetite for gold poses an interesting conundrum for miners to expand their reserve base. During the run-up in the gold price in early 2000s, reserve prices behaved elastically. We can see on the light blue shaded area on the right-hand chart that the spread of those that were more enthusiastic setting reserve prices, and in contrast, those that exercised caution. The fall in the gold price that followed meant that reserves deemed economic at $1,500 per ounce were no longer viable, and as a result, mine lives were shortened and impairment charges soared. This resurgence in gold prices in the second half of 2019 has drawn a lot of speculation as to how miners will respond, and contrary to the last gold rally, producers do generally seem set on building trust among investors and avoiding the mistakes of the past. So we saw little change in the end of 2019 reserve models, in which only a couple of companies among the majors opted to slightly pull up their prices. That being said, if the gold price remains elevated throughout 2020, we do expect that it is going to be awfully tempting for miners to pull some of the less economic ounces into their reserve profiles. especially for those miners that are starting to see even shortening reserve lives profile. However, we're starting to see another trend emerge. Majors are taking increasing stakes in mid-tier and juniors to increase their exposure to exploration upside rather than doing the drilling themselves. A few examples: Newcrest's recent farming agreement with Antipa Minerals, Barrick's alliance with Japan Gold, who Newmont actually holds near 20% stake as well, and Newmont's increasing their stake in Quebec Precious Metals and GT Gold. Most recently, we saw Newcrest acquire a recent project finance package provided to Lundin's Fruta del Norte. The last bull run that peaked in 2011 saw many miners pay excessive premiums for acquisition-driven production growth, based on the assumption that the prices will continue to be well supported. Ultimately, the correction in the prices that occurred was followed by a wave of hefty write-downs. This time around, transaction proposals are being closely analyzed by shareholders. From our perspective, we can expect to continue to see a tightening up of some of these more mid-tier producers, and also the acquisition of some of these outperforming single asset producers. These can only help to mitigate some of the operational risk because if one asset underperforms, its impact is not as harsh if you have a bigger amount of assets. Also, in a market where there's so much pressure to keep a lid on cost, it just seems like a natural evolution for companies that are operational neighbors to get rid of duplicated corporate overheads at the very least. Then you can start to think of some of the operational efficiencies that they might start to gain as the industry starts to work together as a collective to address some of their common issues rather than going at it alone. This isn't particularly a new idea, and it might take some concession from individuals who will have to, at the very least, take a backseat in running whichever new entity is formed, which will for sure be a barrier in some of these transactions. Another alternative to keep production at current levels is, of course, project development. There are plenty of projects out there with over 790 tons of annual gold production that could theoretically come on a stream by 2025. However, early stage projects make up the bulk of those ounces, which are not ready to be brought on the drop of a hat. Another alternative to keep production at current levels is, of course, project development. There are plenty of projects out there with over 790 tons of annual gold production that could theoretically come on stream by 2025. However, earlier stage projects make up the bulk of those ounces, which are not ready to be brought on instantly. As such, there will be a degree of a slippage with some of these projects, and not all of that will be purely dependent on economic viability. The projects which have recently been commissioned and those that are in the later stages of being brought into production have tended to be smaller projects with fairly low capital intensity and lower capital cost in absolute terms. You can see I've highlighted just a sample of some of these, and this doesn't seem like a pattern that will change in the immediate future. The earlier stage projects and even probable projects which don't have board approval yet are markedly more costly both in absolute terms and looking at capital intensity. For a significant chunk of these projects to be brought online, I believe it will take further clarity in the near-term macroeconomic outlook. Brownfield expansions at assets with proven operational performance are likely candidates to receive board approval. Smaller scale greenfield projects that can be commissioned quickly with short payback periods are also likely candidates to benefit from gold's moment spotlight. There are also projects such as Sukhoi Lloyd, McPhillamys, and Back River, which are progressing systematically prior to the rise in price, and they will continue to do so whether the price falls to 1200 or sits well above 1600. Also, one miner's non-core asset is another miner's treasure, and if the price environment remains compelling to bring on gold projects, then we will likely see a heightened interest in acquiring assets such as Massawa that did not meet Barrick's investment criteria. Another theme which could emerge if elevated prices persist is an undertaking to rescope certain projects that currently have fairly dated technical reports, such as Courage Lake and Blackwater, that are seemingly unlikely to proceed in their current capacities. New Gold, the owner of Blackwater, is actually reevaluating the project size by looking at higher grade zones while maintaining a lower strip ratio and lower initial capital expenditure. This might present an opportunity to a buyer willing to see past existing hurdles. Just to sort of put the current price into context, at $1,650 per ounce, 98% of the primary capacity generates a positive NPV at 12% discount rate. And even when looking at our long-term price of $1,350 per ounce, 82% generates a positive NPV, suggesting that this really is a conducive environment to bring on projects if we purely look at economics. But when you think that there is a lot of uncertainty that is driving the price and the pretty aggressive volatility that we have seen, not to mention the macroeconomic headwinds, it is not hard to see why there are still fairly tight grips on the purse strings, at least from some of the more traditional sources of financing. If this continues to be a burden, then I think we can start to see more projects being rescoped and downsized to target smaller, high-grade sections of the ore body before then potentially look towards a phase 2 expansion once the operation is up and running. This has the advantage of lowering the initial capital requirements and shortening the payback period. But all else unchanged, this sort of strategy will be detrimental to the longevity of the asset if you are high grading the deposit over the first few years. Outside of economic viability, there are clearly other hurdles to project development. This image is actually from our sister company, Varus Maplecroft, looking at above ground risk exposure. In these totals, we've actually handpicked a few metrics, such as government stability, resource nationalism, civil unrest, terrorist risk, conflict intensity, climate change exposure, and water stress. Interestingly, this risk exposure map is a pretty reasonable reflection of where we have seen a lot of recent M&A activity. And just general interest from investors looking at lower sovereign risk jurisdictions such as Canada and Australia, largely beneficiaries of this. We have also seen quite a lot of interest in West African mining jurisdictions. Whilst some who are less familiar with operating here may well be deterred from venturing into those countries, this then, of course, does open the door for others, particularly those who have and do operate in these countries and understand what it takes to be successful in these areas. It is a lot easier once you understand and appreciate the risks of operating to begin working on mitigation. Amongst the challenges facing the gold industry, liberating gold from more complex ore bodies economically is becoming increasingly challenging. In 2025, the proportion of oxide ore is expected to shrink to 10% of total ore production. Meanwhile, sulfide ore is expected to become increasingly prevalent and is also the most costly to trade on dollar per ounce of gold basis. Refractory ore is the highest cost on a dollar per ton of ore basis, but due to the nature of the ore being higher grade, this pulls down the dollar per ounce cost. This is something which is calling out for technological advancement to address cost inflationary pressures. Not every mine or company has the luxury of creating a joint venture by which you have the optionality of multiple processing routes at your disposal. But perhaps a greater cooperation between companies with mines in close proximity could help alleviate the cost burden of investing in expensive technologies alone. Advancements in processing technologies are happening in pockets, but they are not yet widespread and seemingly more incremental than game changers. Mines such as Polymetal, who in 5 years expects 40% of their gold equivalent production to come from double refractory ore, are investing heavily in projects such as POX2 that will be fed with ore from at least 4 of their mines. Other mines, such as Core Mining, are implementing high-pressure grinding rolls to help improve recoveries at the Rochester asset. And Polyus has approved the rollout of flash flotation technology at their Natalka mill.